Metal prices would crash. This is the simple, unavoidable answer to what happens when a new, vast supply of any commodity is introduced to a stable market. Imagine a world where the rarest metals, the building blocks of our most advanced technologies, are no longer scarce. This isn't a distant fantasy plucked from science fiction. It is a plausible future, one that engineers and economists are modeling today. The prospect of pulling untold riches from the asteroids that drift through our solar system presents a fundamental challenge to the economic structures that have defined human progress for millennia. The core effect is startlingly direct. More metal means lower prices, an outcome that would ripple through every corner of our global economy with unpredictable force. The journey to this new reality begins not with a bang, but with a calculation. The asteroids in our cosmic neighborhood contain vast quantities of iron, nickel, cobalt, platinum group metals. The amounts are staggering, dwarfing the total known reserves buried within the Earth's crust. For now, the cost of retrieving these resources is prohibitively high, a barrier built of rocket fuel, complex robotics, and the immense challenge of operating in the vacuum of space. But costs fall. Technology advances. What is astronomically expensive today may become merely very expensive tomorrow, and eventually economically viable. The central question is not if this can happen, but when and at what scale. As we stand on this precipice, looking out at a potential future of material abundance, we must grapple with its profound implications. The immediate outcome, a sharp decline in the price of key industrial and precious metals, is just the first domino to fall. This single event would trigger a cascade of secondary effects, tertiary effects. To understand the scale of the potential disruption, we must first appreciate the system as it exists today. The global metals market is a finely tuned machine, a complex interplay of supply, demand, storage, and international trade. Supply, demand, storage, international trade. Supply comes from two sources: new extraction from terrestrial mines, recycling of existing materials. Demand is driven across industries. Construction firms needing huge tonnages of iron and steel, electronics manufacturers relying on tiny amounts of rare metals, cobalt, platinum, smartphones, laptops, electric vehicle batteries. The price of any metal reflects that balance, how hard it is to get, and how much we want it. Bringing new metal to market from the ground is slow, expensive, and full of challenges. Opening a new mine can take a decade or more, starting with geological surveys, securing permits, and environmental approvals, raising billions for machinery and infrastructure, building roads, and even whole communities in remote locations. That delay makes supply inelastic in the short term. If demand for copper suddenly surges, producers can't just turn a tap to add more. The lag creates price volatility as markets scramble against a supply chain that moves at a geological pace. Into this established system, imagine the introduction of a new variable, asteroid mining. Two streams of metal supply, one from Earth mines and recycling, the other from an asteroid, converging on the global market. The concept itself is straightforward enough. Find an asteroid with a desirable composition, send a robotic mission to reach it, extract the valuable materials, transport them back to Earth or to a processing facility in orbit. While the technical hurdles are immense, they are not insurmountable. They are engineering problems, and engineering problems are often solved with time, innovation, and sufficient investment. The key is the cost. Once the cost of delivering a kilogram of space-mined platinum, for example, falls below the cost of digging that same kilogram out of the ground in South Africa or Russia, the market dynamics begin to shift irrevocably. The initial impact would depend entirely on the scale, timing, and cost. A small, steady trickle of high-value metals from a few initial missions would likely be absorbed by the market with minimal disruption. It might cause a slight dip in prices, or slow the rate of price increases, but it wouldn't crash the system. However, the promise of asteroid mining isn't a small trickle. it's a potential flood. The business model for most space mining ventures relies on achieving economies of scale. Price is the central nervous system of a market economy, transmitting information about scarcity and desire. The arrival of asteroid-sourced metals would send a powerful new signal through this system, but its effect would be shaped and filtered by several key mechanisms. It's not as simple as more supply equals lower price instantaneously. The process is moderated by costs, the rate of delivery, the quality of the material, human expectations about the future. Understanding these mechanisms is essential to predicting the nature and speed of the coming disruption, which will unfold over time, not all at once. The first and most important governor on price is the cost threshold. Space-mined metal will only find buyers if its delivered cost is at or below the prevailing market price of its Earth-mined equivalent. No manufacturer will pay $50,000 for a kilogram of space platinum if they can buy a kilogram of Earth platinum for $30,000. This creates a natural floor for how far prices can fall initially. The price will not drop below the production cost of the most efficient producer, whether that producer is operating a mine in Siberia or a robotic facility on an asteroid. This break-even point is the gatekeeper that determines whether space metal can enter the market at all. Second is the rate of delivery, which controls the tempo of the change. Assuming asteroid mining crosses the cost threshold and begins delivering substantial quantities of metal, the initial consequences would be swift and disruptive. The most immediate effect would be a significant price drop for the targeted commodities. The magnitude of that drop would track the size of the new supply versus existing production. If a space mining consortium delivers platinum equal to 20% of the world's annual output in a single year, the downward pressure on prices would be immense, sending shockwaves through the precious metals market and creating a new class of winners and losers almost overnight. This price collapse would immediately threaten the viability of high-cost terrestrial mines. Mining operations around the world have vastly different cost structures. A deep, low-grade ore mine in a high-cost country might only be profitable when platinum is above $900 per ounce. If the influx pushes the market price down to $500 per ounce, that mine becomes a money-losing enterprise. The logical response is to halt production, lay off workers, and place the mine on care and maintenance. That would lead to localized economic devastation, creating unemployment and social unrest. Simultaneously, the incentive structure for recycling would be turned on its head. Low prices reduce the economic appeal of collecting scrap, sorting scrap, and reprocessing scrap. Why invest in expensive tech to extract grams of cobalt from millions of phones when pure, cheap cobalt is available? Companies built on urban mining and the circular economy would face an existential crisis. While that sounds negative, the flip side is cheaper. Raw materials could spur a renaissance in manufacturing, making everything from electric cars to jet engines less expensive to produce. Investment capital, ever watchful for shifting tides, would rapidly pivot. Money would flow out of traditional mining exploration and development companies and into the burgeoning space mining sector and related industries. Banks and financial institutions would have to rewrite their risk models for lending to the resources sector, suddenly pricing in the asteroid risk that was once purely theoretical. This reallocation of capital would create a powerful feedback loop, as investment in Earth mining dries up the development of new terrestrial reserves, slows making the world even more dependent on the new supply from space and amplifying the market power of the successful asteroid miners. The global economy is not a static entity. It is a dynamic system filled with feedback loops that can amplify or dampen initial shocks. The introduction of asteroid metals would trigger several of these spirals. These loops operate over different timescales, interacting to create a complex and potentially volatile transition period. Any disruption, a launch failure, a mechanical breakdown on a mining craft, a solar storm interrupting communications, could lead to a sudden supply shortage and a dramatic price spike. The shock of cheaper metals would not be contained within the mining sector. Its tremors would propagate outward, shaking the foundations of numerous interconnected systems: global trade, manufacturing, national security, environmental policy. The first industries to adapt would be those in the direct supply chain. Car makers might redesign catalytic converters to use more platinum. Battery manufacturers could shift chemistries to favor newly abundant cobalt. This product redesign takes time and investment, but the cost incentive would be powerful, leading to a gradual shift in industrial processes and material dependencies. The geopolitical landscape would be redrawn. Countries reliant on metal exports would face catastrophic income decline. Democratic Republic of Congo, South Africa, Chile could suffer severe fiscal crises and political instability. After a period of volatility and adjustment, the global metals market would eventually settle into a new, stable but altered state. The characteristics of this new equilibrium would depend primarily on where the final costs of asteroid mining settle and how quickly the industry can scale its operations. We can envision two broad scenarios that lie at opposite ends of a spectrum of possibilities. The future will likely fall somewhere between these two poles, with the exact landing spot determined by the thresholds and feedback loops that govern the transition. In Scenario A, a future of modest impact, asteroid mining proves to be technically feasible, but remains a high-cost, niche endeavor. The delivered cost of space metals settles at a point that is competitive only with the most expensive and difficult-to-access terrestrial mines. In this world, space mining acts as a price ceiling, preventing extreme price spikes for certain strategic metals, but not fundamentally displacing Earth-based production. It adds a new, albeit small, stream to the global supply. Recycling remains economically vital, and the majority of the world's metal needs are still met by traditional mines. The change is evolutionary, not revolutionary. In Scenario B, we face a major disruption. In this future, relentless technological improvement, cheaper rockets, advanced AI-driven robotics, and in-space refining drives the cost of asteroid mining down dramatically. It becomes the cheapest source for several key metals. This leads to a profound structural shift. A significant portion of Earth's mining industry becomes obsolete and shuts down permanently. Prices for metals like nickel, cobalt, and platinum fall sharply and stay low. This unleashes a wave of innovation in manufacturing, as products are redesigned to take advantage of material abundance. Global trade patterns are permanently altered, with wealth and power shifting from resource-rich nations to the new titans of the space industry. In either scenario, the transition period would be marked by winners and losers. The winners would be the successful space mining corporations, the manufacturers who can leverage cheap raw materials, and consumers who benefit from lower-priced goods. The losers would be the traditional mining companies, their employees, the communities that depend on them, and the countries whose economies are built on exporting those resources. The new equilibrium would not be a utopia of free materials. It would be a different economic reality, with a new set of rules, a new geography of power, and a new list of challenges to overcome, including managing the environmental impact of increased consumption. While we can model the mechanisms and anticipate the likely direction of change, the future remains unwritten. The divergence between a modest impact and a major disruption hinges on a series of unresolved questions, forming an open loop of uncertainty that no current model can definitively close. Analysts who focus on the immense technical and financial barriers see a long, slow road ahead, where asteroid mining remains a marginal activity for the foreseeable future. Engineers and entrepreneurs, however, point to the exponential pace of technological change and argue that the crossover point of economic viability is much closer than we think. The most critical unknown is the rate at which costs will fall. The cost per kilogram to launch anything into orbit is the single biggest barrier. While companies like SpaceX have made dramatic progress, further orders of magnitude improvement are needed to make bulk transport from asteroids economical. And so, we are left with the ultimate open question. How will we choose to manage the transition from a world of scarcity to one of abundance? What scenario should we explore next? Share your ideas below. You've been watching Ifverse, where imagination meets possibility. See you in our next reality.